Reports suggest a staggering $28, $8 billion, has exited dollar-denominated assets from BRICS nations. This isn't just pocket change. It's a sum large enough to make even the most seasoned financial analysts sit up and take notice. Is this a mere blip on the radar, a calculated strategic move, or perhaps the first tremor of a seismic shift in the very foundations of global finance? From the towering glass and steel canyons of New York to the futuristic skylines of Shanghai, London, and Dubai, the world's financial centers hum with activity, their currencies intricately linked in a delicate dance of power and influence. For decades, the US dollar has stood as the undisputed heavyweight champion of the global economy. Since the Bretton Woods Agreement in the aftermath of World War II, it has enjoyed an unrivaled reign, becoming the world's primary reserve currency, the lubricant for international trade, and the ultimate safe haven in times of crisis. Imagine a vast, intricate web spanning the entire planet, where every major transaction, every international loan, and almost every central bank's emergency stash is tied, directly or indirectly, to the greenback. This dominance has granted the United States immense geopolitical and economic leverage, shaping global events in profound ways. Enter BRICS, a powerful acronym representing Brazil, Russia, India, China, and South Africa. Far from a static club, BRICS has recently expanded, welcoming new members and amplifying its collective voice. These nations, diverse in culture and geography, share a common ambition to foster a more multipolar world order, both economically and politically. Together, they represent a significant portion of the world's population, landmass, and economic output. Their growing influence challenging the long-established unipolar financial system. Stylized maps show lines of cooperation strengthening between these nations, symbolizing a concerted effort to reshape global dynamics. Often, sensational media headlines scream about the imminent collapse of the dollar, painting vivid pictures of financial Armageddon. Yet the reality of global financial systems is far more nuanced, complex, and, crucially, slow-moving. This isn't about an abrupt rupture or a sudden downfall. Instead, it's about influence, about a quiet transition rather than an explosive revolution. While one side of the screen blazes with exaggerated newspaper headlines, the other calmly displays institutional financial data, revealing a much more gradual, deliberate process at play. This brings us to the discourse of de-dollarization. What does it truly mean? In practical terms, de-dollarization isn't an outright rejection of the dollar, but rather a strategic effort to reduce reliance on it. It involves diversifying national reserves away from dollar-denominated assets, increasing bilateral trade settled in local currencies, and exploring alternative financial mechanisms. Think of it like diversifying your own investment portfolio, but on a national scale. Nations are looking to spread their risks, to gain greater control over their economic destinies, and to lessen their vulnerability to external pressures. An infographic illustrating various national reserve allocations would show a gradual, almost imperceptible shift, with the dollar's share slowly but steadily diminishing over time, not plummeting. The goal for many is not to destroy the dollar, but to create viable alternatives and lessen their vulnerability to the monetary policy decisions or potential sanctions emanating from the United States. It's a strategic play for greater autonomy and enhanced bargaining power on the global stage. Picture a set of scales. For decades, the dollar has sat heavily on one side, dominating the balance. Now the collective weight of BRICS currencies is slowly, deliberately being added to the other side, not to tip the scales over completely, but to move them towards a more balanced equilibrium. This brings us back to the elephant in the room, the reported $28, $8 billion exit. What types of assets are being divested? We're talking about significant sales of US Treasuries, a traditional safe haven, and a reduction in holdings of dollar-denominated corporate bonds. And who are the primary actors within BRICS driving these exits? While all BRICS nations contribute, specific data visualizations would show that China and Russia in particular have been at the forefront of this strategic reallocation, signaling a deliberate and coordinated effort to rebalance their financial portfolios away from the dollar. This strategic reallocation within BRICS nations isn't an entirely new phenomenon. History offers intriguing precedents. Throughout different eras, various currencies have held the mantle of global reserve and trade currency. From the Dutch guilder in the 17th century to the British pound in the 19th and early 20th centuries. These transitions, however, were never instantaneous. They unfolded over generations, driven by shifts in economic power, trade routes, and geopolitical influence. Historical maps showing the vast reach of these former dominant currencies remind us that change, though slow, is an inherent constant in global finance. The motivations behind BRICS's current push for diversification extend far beyond mere geopolitical posturing. A primary driver is the inherent risk associated with the dollar's dominance, the power of sanctions. The United States, by controlling the global financial plumbing, can effectively cut off countries from the international banking system, a leverage that BRICS nations, having witnessed its deployment against others, are keen to mitigate. Furthermore, U.S. monetary policy decisions, such as interest rate hikes or quantitative easing, have significant spillover effects, often creating volatile economic conditions for emerging markets. An animated sequence vividly illustrates this chain reaction, showing how a decision made in Washington can ripple outwards, impacting economies across the globe. This desire for greater economic sovereignty, the ability to control their own financial destinies without undue external influence, is a powerful, unifying force within the BRICS bloc. So how are they putting this diversification into practice? One key strategy is the acceleration of bilateral trade settled in local currencies. We're seeing more and more examples. China and Russia settling energy deals in yuan and rubles, India and the UAE conducting transactions in rupees and dirhams. This bypasses the dollar entirely, fostering direct financial links. Another significant move is the substantial accumulation of gold. BRICS central banks have been steadily increasing their gold reserves, viewing it as a timeless hedge against dollar depreciation and a bulwark against geopolitical uncertainty. Charts of BRICS gold holdings show a clear upward trend. Beyond this, there's a concerted effort to develop alternative payment systems. China's cross-border interbank payment system is a direct competitor to the dollar-dominated SWIFT network, offering a UN-denominated alternative for international transactions. Initiatives like BRICS Pay are also emerging, aiming to facilitate cross-border payments among member states. Moreover, the new development bank established by BRICS serves as an alternative to institutions like the IMF and World Bank, offering loans and financing in local currencies, thereby reducing reliance on dollar-denominated debt. Simplified diagrams show how these alternative systems create parallel financial channels. Among the BRICS nations, China's role is particularly pivotal, given its immense economic power. Beijing is actively pushing for the internationalization of the yuan, aiming to elevate its status as a global reserve currency. While the yuan's share in global trade and reserves is growing, as an animation demonstrates, it still lags significantly behind the dollar. This is largely due to challenges such as China's capital controls and questions surrounding its rule of law, which deter some international investors. India, on the other hand, adopts a more pragmatic and balanced approach. While engaging in local currency trade with partners like Russia and the UAE, it also maintains robust financial ties with Western economies. India's focus appears to be less on promoting the yuan and more on strengthening the international standing of its own rupee. A map highlighting India's diverse trade partners and currency agreements underscores this strategic balancing act. Russia's de-dollarization journey has been unique, largely forced by Western sanctions imposed after 2022. This accelerated its pivot away from dollar assets, leading to a dramatic reduction in its central bank's dollar reserves, as a stark chart reveals. While challenging, this rapid shift has also demonstrated the feasibility of operating outside the traditional dollar framework, albeit with significant economic adjustments. It's crucial to remember that these moves by BRICS are not isolated events. The global financial system is an intricately woven tapestry. Every thread is connected. Rapid, large-scale shifts are incredibly complex to execute without causing significant ripple effects. A complex yet clean animated network diagram illustrates this interconnectedness, with the dollar still representing central dominant nodes, but with emerging alternative nodes gradually gaining prominence, suggesting a future of greater financial plurality rather than a singular replacement. The silent transition, often imperceptible in its daily increments, is perhaps the most profound form of change. The $28.8 billion exit, while a substantial figure, is not an isolated event, but a significant data point within a much longer, ongoing trend. It's akin to watching a vast glacier move. Its progress is slow and deliberate, yet its sheer mass guarantees an eventual, undeniable reshaping of the landscape. A time-lapse animation of a vast, slow-moving glacier perfectly symbolizes this measured, yet unstoppable pace of change. For the United States, the long-term implications of a significantly waning dollar demand could be profound, though not an immediate crisis. If fewer nations are willing to hold dollar-denominated assets, particularly U.S. Treasuries, the cost of borrowing for the U.S. government could increase. This might translate to higher interest rates for consumers and businesses domestically, and potentially reduce America's geopolitical leverage, which is often derived from the dollar's central role. However, it's crucial to contextualize these as potential future scenarios rather than imminent threats. A chart showing U.S. government debt and its reliance on foreign buyers of treasuries helps illustrate this delicate balance. Yet the path for BRICS and alternative currencies is not without its formidable challenges. The dollar's dominance is built on decades of trust, unparalleled liquidity, and a robust legal framework. Replicating this level of confidence is extraordinarily difficult. Many BRICS nations, despite their economic growth, still face hurdles in establishing the same institutional transparency, rule of law, and open capital accounts that are crucial for a truly global reserve currency. Their currencies often lack the deep, liquid markets that make the dollar so attractive for international transactions. Furthermore, coordinating monetary and financial policies among such a diverse group of nations, each with its own national interests, presents inherent difficulties. An infographic comparing key attributes like liquidity, stability, and rule of law between the dollar and potential alternative currencies starkly highlights these disparities. The most probable outcome, therefore, is not a simple replacement of the dollar, but rather the emergence of a more diversified, multi-currency global financial system. This future could see the rise of regional currency blocks, where the yuan plays a dominant role in Asia, the euro in Europe, and perhaps specialized payment systems catering to specific trade corridors. A world map with different regions highlighted, each with a dominant regional currency symbol and intricate interconnecting lines, vividly portrays this multicentric financial landscape. Beyond traditional fiat currencies, the digital frontier is also poised to play a transformative role. Central bank digital currencies from various nations, including BRICS members, hold the potential to further facilitate cross-border transactions outside the traditional dollar-centric rails. These digital innovations add another layer of complexity and innovation to the evolving financial architecture, represented by an abstract animation of digital currency flows. Ultimately, financial markets are deeply influenced by confidence and perception. The narrative surrounding de-dollarization itself, whether driven by geopolitical motivations or economic realities, can become a self-fulfilling prophecy to some extent. As more actors believe in and act upon the idea of diversifying away from the dollar, that belief can gain momentum, influencing real-world capital flows. A brain-like animation with nodes representing information and perception influencing market sentiment underscores this psychological aspect of finance. We must look beyond the sensational headlines and delve into the underlying economic and geopolitical forces at play. The world isn't hurtling towards a financial collapse, but rather towards a significant rebalancing of economic power. The question isn't if this shift will occur, but how it will unfold and when its full effects will be realized. Understanding these nuanced shifts allows us to navigate a complex, evolving world with greater clarity and foresight, preparing for a future that promises to be more multipolar and interconnected than ever before. The journey is long, but the direction is set. A thought-provoking image of a compass spinning, then settling on a new, more diversified set of directions, fading out on a global financial map showing interconnected yet distinct power centers, leaves us pondering the road ahead.